Welcome everyone. My name is Nikki Johnston and I'm with Transition Advisors. Our webinar today is Understanding what your partnership agreement should include. Before we begin, we need to cover a few important items. First, please close any other programs that are running on your computer. This will help to ensure quality presentation and reduce any audio issues. Transition Advisors LLC is a proud and approved sponsor on the National Registry of CPA Sponsors per NASBA. In order for you to receive your 1 CPE credit for today, you must complete 2 requirements. First, you must participate in 3 of the 4 polling questions throughout today's presentation. And please note that GoToWebinar does monitor your participation in these polls. Next, you must complete an online evaluation. If you registered for today's webinar directly through Transition Advisors, you'll receive a link to that evaluation in an email from me later this afternoon. Once these requirements have been met, the certificate will be emailed to you within 10 business days. There is an additional very brief survey that will appear immediately after the session ends. This is not required in order to receive your credit, but your input is appreciated, and this will help us provide you with quality programming. Now, in order to fully participate in the webinar, please take just a moment to familiarize yourself with your GoToWebinar control panel. It should be on the right-hand side of your screen. There is an orange arrow near the top of the panel that will minimize it. During the presentation, all participants are muted, but you can communicate with us by using the question box toward the bottom of that control panel. Just type your question in the box and click Send. Questions are important to us, and time permitting, we will answer all of your questions during the presentation today. Finally, I'd like to remind you that Transition Advisors offers a free 1-hour CPE webinar each month. Our upcoming topics include 7 steps to M&A, admitting partners and valuing equity, and a roadblocks to avoid session. For a complete list of all of our webinars, including links to register for them, you can visit the CPE courses section of transitionadvisors.com. Now, just as a quick reminder, there was a link in the email reminder to download the slides if you'd like to do that in advance. I also just sent a link via the chat function. If you'd like for me to email you a PDF of the slides after the webinar, you can indicate so in the survey that will pop up on your screen. Now I'd like to introduce our presenter for today's session. Terry Pane is the CEO of Transition Advisors. Thank you so much for joining us today, and we hope you enjoy the webinar.
Thank you, Nikki. Just another reminder, this session is being recorded and can be accessed through our website after it's been loaded on by the end of this today, which would allow you to go back, obviously, and listen to it yourself if there's something you wanted to remind yourself of. Or you may refer a colleague to the session so that they can, experience what you've experienced today. Transition Advisors is a national consulting firm. We work exclusively with accounting firms and only on issues related to ownership transition. That involves, we are involved heavily with mergers and acquisitions and do searches and negotiations and deal structuring and valuations, introductions of the parties, or we also work with firms who have found their merger and acquisition party on their own and just need help with how to do the deal, how to structure the deal, and so forth. The other major area that we're involved in is succession planning and ownership agreements, and that's the topic for today. Probably be involved in somewhere between 25 and 30 restructuring of ownership agreements this year, and it's an area that I'm personally heavily involved with. I wish that I could sit with each of you across the table and just talk about your specific situation and address these comments to what your situation needs. In the event that you do have any questions about your own situation, feel free to email me, or you can contact me by phone. We'll give you that contact information at the end of the webinar. You can also ask questions, as Nikki mentioned, throughout the webinar through the chat box. The issues that we're going to address today, and we have not quite an hour to do that, so we're going to be obviously at somewhat of a summary level here, will be compensation, equity, how to define and allocate it, governance issues, retirement and other terminations, including how to value the value of an owner's interest in your firm, how to admit new partners, and other miscellaneous matters that need to be addressed in partnership agreements. With that, we're going to start with one of our polling questions, and part of this is so that we get an idea of kind of what the current situation is for the people that are on the line. So, Nikki, I'll turn it back over to you for the polling question, first polling question.
Okay, sure. You'll see the polling question there on your screen. This first question is, does your firm have an owner agreement? Your options are yes, and it's signed by all owners. Yes, but it's not. Not all owners have signed it. No, but we need one. No, and we're not sure we need one. So take just a moment here. We'll let everybody have a chance to answer. I'll leave it open for about 5 more seconds. Okay, I've closed the poll. The results are shared there. Terry, it looks like 45% indicated no, and we aren't sure we need one. 39% said yes, and it's signed by all owners. And then 10% no, and we need one. And then the final 6% indicating yes, but it's not signed by all owners.
Okay, and those results are kind of what we expected. You know, we oftentimes find that firms get into a situation where they, you know, as they formed their firm, at the time it was sort of like, well, this is kind of informal. We really don't need to do anything here because we're just kind of slamming together some books of business. You know, over time, things evolve, and we just never really get around to putting an agreement together. And I think when it becomes obvious that you need one is when somebody's getting ready to leave, and you're like, well, how do we deal with, you know, that exit? How do we deal with buying them out? And that oftentimes leads to the need for a new agreement. It also leads oftentimes to the need to address changing an existing agreement. And we're going to talk about how to do that throughout this webinar. You know, the types of compensation plans, and I'll talk about each of these briefly, that we run into would be ones where where each partner is paid the same amount out of the profits, a seniority type system, a pure formula type of system where we have a series of performance metrics that we're measuring that decide how we're going to allocate compensation, cross-evaluation, equity-based, and committee or leader-based compensation systems. You know, equal compensation systems are often the result of a new partnership formed from scratch. So there might be two people that leave a firm. Oftentimes they weren't partners in the firm. Maybe they were at manager level, decide to start a new firm. And the most important thing we can do at that point is start building a book of business. And so it's kind of one for all for one. And that leads to, you know, we're not going to worry about who did what. We're just going to worry about trying to get this firm off the ground. And so it seems to us that equal might be the best way to go. It also promotes collegiality, and, you know, it is a simple way to approach it. In order to sustain that long term, we need to, you know, we need to have equal contribution from all the partners, and that's where the problem usually comes in. And often long term, we also run into a problem if we keep this system too long, that we're not promoting high performance. So an example that I've recently run into would be a firm that two partners from one firm left, joined two partners from another firm. There was a lot of turmoil involved because there were some issues related to their ability to leave with clients at both firms. And so again, in order to get the firm pulled together and have everybody focused, it seemed like, you know, equal contribution or equal compensation was the way to go. We're now looking at a situation where, you know, some of the partners are managing over 2 times what other partners are managing, and it's obvious that the contribution isn't equal, and so we're needing to work on a new compensation system. Equity-based is often used in new partnerships that are formed with existing books of business. So I might have, say, a $700,000 book of business, and I join with somebody who has a $500,000 book of business, and we might decide that I should be paid 7/12 of the I should be allocated 7/12 of the equity, and therefore I receive 7/12 of the compensation. And again, that works as long as those ratios are maintained. When they start to get completely out of whack is when you know, those systems don't work. The other issue that occurs, of course, is when equity is accumulated through the buyout of other partners. So I might have started off as a 20% partner, but we've now bought out, you know, 3/4 of the people that I was originally partners with, and all of a sudden I find myself owning 50% of the firm, but I'm clearly not generating 50% of the contribution to the profit pool. So In a system that maintains an equity type allocation for too long, when the equity doesn't reflect the contribution that's being made, we can run into problems. A seniority system is similar to an equity system. Oftentimes we're dealing with units. We might decide that we're going to allocate units based on current performance, a combination of current performance and how long we've been at the firm. So the longer I'm with the firm, the more units that I accumulate. And oftentimes those systems will set the compensation allocation at the beginning of the year based on the units owned at the beginning of the year. And we adjust that each year, but that adjustment affects the next year's compensation. Again, those work well until they get out of line with people's contribution being completely out of line with their compensation, oftentimes because a partner is in a transition mode or in a senior partner mode where they're really not performing at the level they used to, and too much of the compensation is based on prior years. This is a system that, quite frankly, is used in a lot of law firms, and as you may have clients that are law firms, you can see where sometimes those don't work. I think what I run into more often than either equity-based or would be formula-based systems. You know, a formula-based system looks at particular performance metrics. Usually the ones that rise to the top would be chargeable hours, managed book of business, new business developed, and sometimes variations of those. So we might be looking at chargeable hours that I produce on my own book of business differently than chargeable hours that I might produce on another partner's book of business. But again, a formula that somehow tries to turn into a quantitative analysis, what may or may not be quantitative. And so we don't have to worry about, you know, making any subjective analysis of each other. We'll just go through the formula, and that'll kick out the answer. And I think the thing that we run into that causes problems here, of course, is that we're all accountants by definition, and we all can figure out how to manipulate that kind of a system to our own advantage. And so when the manipulation is for the benefit of the firm, that's good. When the manipulation is merely a way of getting around the system so that I'm allocated more compensation, not necessarily for the benefit of the firm, then it's a problem. So an example would be a system that puts too much weight on chargeable hours. What that's incenting me to do, of course, is produce chargeable hours, but if it demotivates me from delegating work and therefore creating more growth for the firm, then it's not for the benefit of the firm. Cross-evaluation systems usually are what is the next level. When we come from a formula-based system, we realize we're leaving out a lot of subjective analysis. So how do we go through the subjective analysis? Most firms in their growth oftentimes are not ready to delegate that kind of responsibility to one person who would be the managing partner. And so we say, well, we're kind of all in this together. We're all sort of democratic in the way we govern this firm. Let's do a cross-evaluation. I'll evaluate all the other partners. They'll evaluate me, and we'll see how those evaluation systems come out. And that's how we'll deal with the subjective issues. So this would allow us to evaluate things like, staff development, marketing that doesn't result directly in new business developed, and so forth. And we see this again in firms that are maturing from what might have been a democratic type of environment to one that's more leader-driven. A leader-driven system, of course, puts a lot of the weight, and I think a leader-driven system in a committee-based system, which is the next slide, are really similar. It's just a matter of how many people are involved in the decision process. But it basically says we trust this person to make good decisions about how compensation should be allocated, and we're going to put that responsibility on that person. And we see that being used again in firms that have reached a mature state with respect to governance. How do you choose the right system for your firm? The first thing you want to remember is that the culture of your firm is going to be defined to a great extent by your compensation system. So if we're going to, for instance, pay partners for managing books of business, we're probably going to end up with what would not be considered a one-firm concept, a one-firm firm. Therefore, people are going to focus on their own books of business, maybe to the expense of what's good for the firm as a whole. If we're going to focus heavily on chargeable hours, we're going to end up with partners that are heavily oriented towards their own production and maybe not towards the other issues that would help grow the firm or the other things that require leadership. So the first thing to remember is you get what you pay for, and the culture you create within your firm is going to be defined to a great extent by your compensation system. The other thing I'd point out is that the best performing firms will have anywhere from 20 to 40% of their compensation that's performance-based and usually at risk and paid at year-end or maybe sometimes throughout the year. But 20 to 40% of their compensation is going to be paid in the form of some kind of performance-based system as opposed to base compensation. And the other ratio that I'd point out is the best performing firms typically have at least a 2-to-1 ratio between the top paid partner and the lowest paid partner, and oftentimes as much as 3 to 5 times as much. And the reason why that's important is that a firm that doesn't recognize that there can be that kind of differential in compensation is probably not, either doesn't have high-performing partners or isn't paying them and motivating them to maintain that level of compensation. So rather than, even though that may sound like a system that creates a lot of turmoil, that kind of turmoil actually should result in a high performance. When you are moving from one system to the next, I think the thing that hopefully you can do is deal with the effect that this is going to have on an individual partner through growth rather than as a punishment. So if we can say, look, we're all at this level now, as we move to this new system, the effect that change is going to have is going to be hopefully mostly allocating new growth, and we don't have to ask anybody to take a substantial cut in pay in order to make the change to the new system. Now, if it's justified, obviously it has to be done. But if it can be done gradually and in a way that doesn't affect any individual in too much of a negative fashion, usually that will be accepted by the partner group better. The next thing I want to talk about is equity. What does it mean in your system? Well, I think it makes it important in deciding how you're going to deal with it. Equity can affect your compensation if you have that component within your compensation system, which usually is in the form of profit sharing. It can affect how you make decisions. It can affect how internal buyouts are allocated, and it can affect how external buyouts are allocated. The thing that you want to worry about here is when you have too much concentration of equity in one person, and that skews any of these issues, then that's when you have an issue. So I'll give you an example. I ran into a firm, it was several years ago, where the firm had started off as a 6-partner firm, and over time, most of the original partners had been bought out. We woke up one day, well, they woke up one day only to find out, and of course it didn't happen suddenly, that one of the partners owned 60% of the firm. And as a result of that, that partner felt like under their partnership system, he should be paid a disproportionate amount of the value of the firm, and the other partners resisted, said, you know what, I know that's what the agreement says, but we're not going down that road. It doesn't reflect reality. And as a result of that problem, the firm broke up because they had not ever really addressed what equity really meant in that firm and how it should be allocated. Normally, if you've got a situation where a partner owns, something more than 50% of the equity of the firm, unless this is a clear situation where that partner is heavily controlling the firm, heavily controlling the business of the firm, and the other partners are clearly junior partners, excuse me, you want to find a way to either reallocate the equity or minimize the effect of the equity. And we'll talk about some governance issues later on in this presentation. But I think that where we see a lot of need for an external solution to succession planning, oftentimes is driven by a disproportionate allocation of equity to one person. With that, Nikki, I'm going to turn it back over to you for the next polling question.
Okay, the next polling question is on the screen. The number of owners in my firm is, and you can indicate there that you're a sole proprietor, 2 to 4, 5 to 9, or 10 or more owners. So just a reminder, this is our second polling question, and you do need to complete 3 in order to receive your CPE credit for today. I'll give you just a couple more seconds. This one's pretty straightforward, so if you haven't indicated your answer yet, please do so. Okay, the results are on the screen there. It looks like 56% of the folks on the call are sole proprietors, 30% have 2 to 4 owners, 10% have 10 or more, and then the remaining 5% have 5 to 9 owners.
Okay. It tells me that a lot of the reason why I guess the sole proprietors would be interested in this was probably because they're considering admitting a new partner, and we'll spend some time on that. That obviously is, you don't have, if you're not going to admit a new partner, you don't need a partnership agreement. But that is something that we're dealing with more and more because, you know, as we all have heard, and we've been to, all of us have been to enough seminars and webinars to know that succession is a huge issue in our profession right now. 75% of the members of the AICPA are going to reach retirement age, which will be defined as 65 within the next 10 years. So most firms are in a situation where they're either going to have to find successors from within the firm, or they're probably going to have to look for an external solution. So what we see with a lot of sole proprietors is their first preference is, of course, to do this internally because it minimizes the change. It gives them control over the process more so than they see an external solution doing. And so they're looking at, some of their staff and wondering, is this somebody that we can promote, and how would I do that, and how much do I charge them, and so forth. I assume that's what the interest is from those of you on the webinar that have that situation. In looking at the different kinds of partnerships, partners, you've got full equity partners, and we see in many firms, the larger the firm, the more likely you are to have what would be considered senior and junior partners. What we see oftentimes in firms that have 25 or more partners is that most partners would have an equal equity allocation. So if we have 25 partners, we all might own roughly 4% of the firm. Now, where we start seeing some variation from that would be where we identify different classes of equity partners. So we might have 2 classes where the senior equity partners might own, say, 6% each, and the junior equity partners might own 2% each, and that gives you the ability to recognize the ongoing development of a partner once they become a full equity partner. Income partners and non-equity partners is becoming a very popular technique that's used by firms for two specific reasons. One is to delay the admission to full equity partner to give the firm a chance to measure full development of that person, and the second is to give them a permanent parking spot for people that are very valuable commodities within, or people within the firm, but people that we don't believe deserve full equity status. Contract partners oftentimes are the result of mergers and acquisitions. A technique that we use a lot in mergers and acquisitions is what we call a 2-stage deal. In a 2-stage deal, a person comes in with the primary objective of transitioning their book of business over the course of, say, 2 to 4 years. And during that time, we want to hold them out as a partner to their client base and to the community as a whole, but we don't want to bring them in as a full equity partner. So we define their role through a contract that defines their compensation and defines their buyout, and that therefore there would be considered a contract partner. Now, of course, they're not called that. They're not given that title, but that defines, the relationship we have with that person. And then of counsel and emeritus partners would be normally partners who are in transition or have retired. We want to keep them as a part of the firm because they have the ability to bring in additional business, because it helps promote continuity as far as the community is concerned, because the person has a lot of brand equity within the community, but oftentimes their role is very minimal with respect to the firm operations. A little more information on the non-equity status. the surveys, the Rosenberg survey, which the annual survey, which I highly recommend, indicates that 80% of firms that are over 20 million in size have non-equity partners, and 46% of all the firms that responded to the Rosenberg survey, which includes firms as small as even $1 million, have non-equity partners. What we're seeing is that the popularity, I believe, is because firms are reluctant to designate a full equity status to partners, to candidates, because of the consequences of potentially of that not working out. But they want to see this person function in a partner role to make sure that they're making a good decision about their final promotion to full equity status. That's a very positive reason to do that. I think when you're going to go down that path, you want to make sure that you have a goal for how long that person can stay in that role. It shouldn't be longer than probably 2 or 3 years. Now, other firms have said, you know what, we've got people we know that we will never be a full equity status. Maybe they're not very good at practice development, is usually one of the problems they might have. And in those cases, we still want them to be a partner because we want to give them the kind of responsibilities partners have with respect to client service. So we'll permanently put them in a non-equity status. We don't see that being used as often as we do for the developmental process. We also see non-equity status used in mergers because if you bring somebody in, let's say we're merging with a firm that's a $2.5 million firm with 5 partners. 1 or 2 of those partners might be people that aren't performing at a level that we would normally require of an equity partner in our firm. And so rather than demote them too far, we demote them to a non-equity status for purposes of the merger or acquisition, with the idea in mind that they have a path to equity, in a short course if they can demonstrate that they can perform at that level. We talked about governance a little bit with respect to equity. Governance, the issues around governance will, of course, be day-to-day decision-making, whether or not you require unanimous or supermajority or simple majority votes, and what kind of financial commitments a person has to make with, or what kind of financial commitments are governed by the governance issues in your partnership agreement. A supermajority vote might be used, for instance, for admission of a new partner. So a supermajority vote might be that we require that 80% or more of the voting equity within the firm has to be attained in order to reach a supermajority decision. So it's something less than unanimous, but something more than simple majority. Oftentimes we'll use a supermajority. I think supermajority votes are actually a very useful tool in a partnership agreement. And we normally have 5 or 6 things that would require supermajority votes. For instance, admission of a new partner, termination of a partner, a merger or an acquisition, or the purchase of a very large, or the use of a very large financial commitment. Simple majority votes typically would be required for, sort of the more mundane type of things that the firm might be used that are beyond what you want to delegate to a managing partner, but you want to involve the partners in, things that aren't major decisions. And then unanimous decisions oftentimes would be used for the most major decisions like dissolution or sale. However, I would warn you that when you have the use of or when you have unanimous decision requirements in your agreement, you're setting yourself up actually to place a lot of control in the role of one person. So let's say, for the most extreme example, we have 5 partners in the firm. 4 partners each own 24% equity, and 1 partner owns 4%. And if you have a unanimous decision required for anything, that 4% partner actually carries as much weight as all the other 4 partners. And that probably is not what was intended. So, for instance, if we have a merger that we want to do, and this 4% partner decides they don't want to do the merger doesn't go through because you required a unanimous decision. So I very rarely would recommend the use of unanimous decision in partnership agreements, but unfortunately I see a lot of agreements that have that requirement. Let's talk for a minute about mandatory retirement ages. This is a very contentious issue and something we have to deal with in most of the projects I'm involved in. When you have, if we're going to have a mandatory retirement age, normally I'd see that be between the ages of 62 and 70. Most agreements I see are either 65 or 67, or they might tie the mandatory retirement age to the Social Security retirement age for full benefits, which right now I believe is around 66. First off, when we talk about mandatory retirement, we're usually not talking about actually leaving the firm. Now, some agreements do in fact say that, but most of the time what we're talking about is that you have to go into buyout mode and your compensation now becomes different if you're going to continue working. It might be, for instance, on the basis of a percentage of billable hours. So a mandatory retirement age of 65 might say you don't have to quit working at age 65, but you do have to at that point relinquish your ownership in the firm and have your retirement start. Should your agreement include one? I highly recommend that your agreement does have a mandatory retirement age. And the reason for that is that without one, the firm is kind of flying blind as to when people are going to leave. So if we don't know that a person might leave at age 65 or might leave at age 70 or might leave at age 75, how do we plan for their replacement? Even if we have, a 2-year notice period in the agreement, we can't get the resources in place in time to replace that person usually without some kind of idea of when that's going to happen. So for the most part, a mandatory retirement age allows you to control, getting replacement resources in place. This is something that I'd be happy to talk to you more about because each situation is different, but it's one that I think is very important. Vesting, when is it appropriate and how long should it be? I think this is really critical if you're bringing new partners into your firm. If all 4 of the partners have been in the firm for 15 or 20 years, have been partners together for 15 or 20 years, vesting is probably not an issue. But if you're bringing a new person in, the reason you're bringing them in, of course, is to create a succession team. And what you want to make sure that you do is you have that person in place to actually execute the succession. So what the vesting does is it says, look, we can allocate value to this new partner and have them accumulate value, but they can't actually cash in that value until they put in a certain amount of time or they've reached a certain age, and that age or time is staged so that they're in a position to provide, the succession that is the reason why you brought them in the first place. What we're seeing is typically vesting on a 10-year basis would run between 10 and 20 years with some sort of cliff vesting. I oftentimes recommend 10 years, 50% vesting, 15 years fully vesting, or 20 years fully vesting. If we're going to talk about age vesting, normally we're talking about some sort of partial vesting at age either 55 or 60, with full vesting at age either 60 or 65. And oftentimes we might have a 50% at age 60 with 100% at age 65. So again, what this is designed to do is make sure that the newer partners that you're bringing in to the firm are in place to provide the succession that you need for your senior partners. That's the primary use of vesting, in my opinion. When we talk about retirement and buying out equity, there are basically 4 different approaches to this. The book of business approach, the equity approach, a compensation approach, and then hybrids of those. Before I get into that, I want to get into another polling question. So I'll turn it back over to you, Nikki.
Okay, here's our 3rd polling question. This one says, I believe our approach to valuing our owner's interest in the firm is, your options are fair and affordable, fair but I'm not sure we can afford the buyouts, not fair because too rich, not fair, too low, or it's not applicable, we don't have an agreement. So we'll give everyone a few more seconds to indicate their answer. And I'll go ahead and close the poll now. There's the results. It looks like 55% it doesn't apply to them. 28% indicated fair and affordable. and then 13% fair, but I'm not sure we can afford the buyouts. And the other two, the not fair ones, just 1% and 3%.
Okay. And obviously, not being able to afford the buyout is the reason why a lot of agreements are being modified these days. And I think that what I'm going to show you is an approach that you can use to evaluate the affordability of your agreement so that both the parties that are being bought out and the parties that are going to be doing the buyout feel comfortable that this is a plan that will work and it's fair. And we'll get into that in just a minute. The surveys tell us, and this is from the 2012 PCPS Succession Survey. If you don't have a copy of this, I highly recommend you get a copy. There are two surveys. One is the Sole Proprietor Survey, which primarily talks about how sole proprietors are going to eventually dispose of their interest in the firm and some of the issues around that, for instance, timing and so forth. And then the multi-partner firm survey, which is where this comes from, addresses issues that are in partnership agreements. The survey tells us that 37% of the firms that responded use the equity method of valuing an individual partner's equity in the firm. The equity method says I own X% of the firm based on some, it could be the stock that I own if I have a corporation. It could be the designated equity percentage that I own if I have a partnership or an LLC. Let's say I own 30% of the firm, and we decide that the firm as a whole is worth whatever it is. Let's say we use 1 times equity or 1 times volume. If it's a $2 million firm and I own 30%, then I might be allocated $600,000 of value in that case. 16% use the managed book of business, which says I'm managing a $700,000 book of business. That is therefore worth some multiple of that. Let's again say 1 times. Therefore, my equity is worth $700,000 in the firm. Someone else who owns a $500,000 book of business would have a $500,000 value. 22% use a multiple of compensation. Oftentimes, this is defined as the 3 highest years of the last 5 years compensation. So if my average compensation, the 3 highest years in the last 5 years was $250,000, and my multiple was 3 times, that'd be a $750,000 value, and that's how my equity would be valued in that case. And then 25% of the respondents use some other method besides those 3. Sometimes those methods are just an established number. We might say everybody has a $500,000 ownership interest, or it might be a combination of the above. 50% of it might be determined based on compensation and 50% based on equity. When you look at what a firm is worth, there's 2 ways that I think you need to consider. One is you need to look at your peer group. What are other firms doing? And we'll talk about that in a minute. But what is a firm like mine typically doing? That's a guide to what you maybe should consider doing. But the more important issue is what we call the backwards valuation. The backwards valuation says you want to reward your retiring partners for all the years of sweat equity, for building the firm and so forth, but you shouldn't expect your remaining partners to borrow or take a step back in compensation to do the buyout. That's typically what the fear is of younger partners when we get involved in the need for a new agreement. Their fear is we can't afford. When you say I can't afford to do this, that's in essence what you're saying. Is if I go through this buyout, I'm probably going to make less money than I was making before. Why would I want to do that? Or I'm going to be making the same amount of money for the next 10 years while I buy this person out. Why would I want to do that? So in doing that, backwards evaluation, keep in mind that what you have available as capital to buy out a retired partner is their foregone compensation. And there's 3 things that we're going to use that capital for. 1 is to pay them off, 2 is to replace them, and 3 is to create some upside for the remaining partners so they're motivated to assume the obligation and all the extra work that that's going to create. Let's go through an example of that. So we've got, let's say, a retiring partner whose comp and benefits is $300,000. We might decide that their replacement resources are $120,000. Now, this is something that can be all over the board, but one of the ways that I typically approach this is to look at what their productive capacity is. If the partner was producing, say, 1,200 billable hours at $250 an hour, that's $300,000 of production on their own time. At the very least, their replacement is going to have to be what it costs to produce $300,000 of billable time. Because when they quit producing those hours, someone else is going to have to produce them, or obviously we're going to fall back in revenue. Generally, the rule of thumb is about 40% of billable time is what it costs to buy that time off the street in the form of staff time. So in that example, we might say replacement resources are $120,000. Now, of course, you can't actually replace a partner for $120,000, but the rest of the duties that that partner has are going to be assumed oftentimes by the other partners. That leaves us with $180,000. So now we need to decide how much of that $180,000 we're going to use for the buyout and how much we're going to leave behind for the remaining partners. So a more specific example might be a firm that has a volume of $1.9 million. The retiring partner has a 45% stake. Their comp and benefits might be, in that case, $275,000. Capital account might be $175,000. We're going to set up the buyout over 5 years, and that includes 5 years for their 45% equity interest plus 5 years for their capital account. That works out to $171,000 per year. In this case, if their cost of the replacement resources were $125,000, this is what that looks like. In the first year, we've got $275 less than $125, which is leaves $150,000, less $175,000 for the capital account, less another $171,000 for their retirement benefits. So we have $146,000 of negative cash flow each year for the first 5 years. I would not call that affordable. I mean, I don't think any of you would either. In years 2, or that's in the first year because we paid all their capital in the first year. In years 2 through 5, we have $150,000 less than $171,000, or therefore $21,000 of negative capital. I see a lot of agreements that are structured this way, and obviously people are looking at it going, how are we going to afford this? An alternative plan for this might be to pay the capital back over 5 years and pay the retirement over 10 years. What impact does that have? Now, of course, we're not asking the retiring partner to take less money. We're just asking them to take it over a longer period of time. So we still have the $150,000 left in capital. We have $35,000 a year that we're going to pay in the capital account, and we're going to have $85,000 for retirement. Therefore, $29,000 of positive cash flow in the first 5 years and $64,000 in the next 5 years. I don't think that that's necessarily enough. I think that, but at least it demonstrates that it's the cash flow is positive, and you might consider that kind of a plan affordable. In looking at external benchmarks, we have found, again, this is based on the PCPS survey, less than 10% of the firms out there are using right now more than 100% of revenues as their valuation metric. 40% are using 100%, which is still the most popular, but less than 50% of the firms are doing it nowadays. And almost 30% use between 75% and 100%. But definitely the trend is downward on internal valuations, and I think we'll continue to see that because firms are trying to take the pressure off of their retirement obligations. In terms of firms that use compensation as a multiple metric, about 40% are using 3 times, about 15% are using 2.5 times, and between 15 and 20% use 2 times. I've seen as low as 1 times. I think that's too low, but I do think that most firms that are using this metric would use somewhere between 2.5 and 2.75, and nowadays that's becoming kind of the norm. So when you look at how to restructure agreements, the terms that you can focus on are the payout periods. I mean, if we've got a plan we feel like is too rich, one of the issues we can do is stretch the payments out. I've seen payment plans that go as far as 15 years. Oftentimes it's at least 10 years. It's difficult to put a deal together that makes sense anymore that is probably less than 10 years. We need to deal with retention periods. We didn't really don't have the time to talk too much about that today, but is the deal going to be based on the retention of clients following retirement, or are we going to rely on an adequate notice period? If you're going to use a notice period, I think it should be at least 2 years that a partner should be required to give notice of their intention to leave. That gives the firm time to execute a transition plan. Failure to provide that 2-year notice might result in a deal that's contingent based on post-retirement retention. Tax structure, if you're in a corporation, it's pretty difficult to get capital gain treatment for the buyout, because the only way you can do that is to buy the stock, which is non-deductible for the corporation. So most corporations would have to use deferred comp. If you're in a partnership form of entity, then you can buy a member's interest. And although that would require a 15-year amortization, it does allow for a capital gain treatment. And if the payment period is, say, 12 to 15 years, then you've matched up the cash flow with the tax treatment. Most agreements have caps on the amount that can be paid in any 1 year to retiring partners, and we're talking about usually a cap of around 8%, anywhere from 6 to 10% of revenues of the firm, with 8% being a very popular one. Penalty buyouts would deal with the premature exit, either through the use of vesting or through the failure to provide adequate notice. And then how do we deal with situations where a partner has been terminated? And most agreements I see would treat a termination as a partner who's left without providing adequate notice but still paying them out, unless the termination is for commission of a felony or loss of the CPA license or something like that. Here's our final polling question, I believe. Nikki, I'll turn it back over to you.
Sure, this is our fourth and final question. This one, does your firm have adequate talent on the bench to replace retiring partners? And here your options are yes, and we're confident our approach works. I think so, but we don't know how to admit them. No, we don't have the talent we need, or we don't plan to pursue internal succession. And just a reminder, this is our fourth polling question, and you need to answer 3 in order to get your CPE credit. So if you haven't yet indicated your answer, please do so now. I'll go ahead and close the poll and share the results. 38% say that they don't plan to pursue internal succession. 32% do not have the talent they need. 20% are confident that their approach will work, and the remaining 10% aren't sure how to admit those partners.
Okay. Maybe we can give you a little bit of guidance on new partner buy-ins. The questions are how much to charge coming in, how much equity should you allocate, what's fair for both parties, should you use vesting, and how do you deal with compensation? The thing to consider on compensation, I just had a conversation with somebody this morning about this. The more you charge somebody up front to join the firm, the more pressure you're putting on the need to provide them additional compensation. So even though it may make sense to say, gee, I want them to have a lot of skin in the game, or I want to make sure I'm not giving away the equity, if we're asking them to make a huge investment up front, then we need to provide a return on investment for that to make sense. And it may not make sense for you to, to provide the kind of additional compensation that requires. The additional compensation, I believe, should come from enhanced performance, not from the fact that they made an investment in the firm. New partner buy-ins consistently, according to the 2013 Rosenberg survey, run between $120,000 and $160,000 for all size firms. That's the initial amount of investment that's required. I don't know that it necessarily means writing a check up front for that amount of money. We are seeing firms increasingly using external financing for purposes of new partner buy-ins, but it also makes sense sometimes to allow for the buy-in to be made over a 3 to 5 year period. But if that's generally what we're seeing most firms of any size do in terms of the upfront investment. But I don't know that it necessarily makes sense in every case. Oftentimes, what we would recommend is that we look at the tangible book value, which would include the receivables and WIP. And if we're going to allocate, say, a 10% initial equity, that we charge them based on the 10% of the accrual basis, Now, what that means, of course, is that we're not going to give them, access to the rest of the value, the intangible value, and we're going to manage that either through vesting, where we, in essence, defer their ability to accumulate that additional equity for a long period of time, or we're going to use some kind of unit approach where we allocate the intangible value differently than we allocate the capital accounts or the accrual basis value. As far as how much equity to allocate, it just depends on the size of your firm. I generally don't see new partners coming in for more than, say, about a 20% stake up front. So let's say we've got a $2 million firm. We're going to bring them in at 20%. Usually the capital account in that case capital would normally run between $400,000 and $500,000. We might charge $100,000 to come in for a 20% stake. And then that 20% would only apply to the capital account, and then they would share in the growth of the firm beyond the $2 million based on their participation in the long-term growth of the firm, and then of course vesting can also be used to layer over that. Termination issues, you need to decide, how a partner can be terminated in terms of governance. What kind of non-compete you're going to place on a partner that's been terminated, what the cause might be. Oftentimes cause is limited to felonies, loss of license, but in some cases, your partnership agreement may just be, we don't want you to be a partner anymore. So that's usually an issue we've got to deal with, and depends on the culture of your firm. Other thoughts before we finish? Dealing with death and disability, highly recommend this death and disability be insured in your agreement. External sales and dissolution should probably be dealt with in terms of making sure your equity fairly represents an allocation of value, so that when you have an external sale, you're not having to renegotiate your deal. All agreements should have a non-compete unless you're going to allow your partners to take clients. And I'd say most agreements I see nowadays do not allow a partner to freely take clients. With that, we are at the end of the webinar. Ran over just a few minutes. Again, I invite you to contact me with any specific questions that you have with respect to your firm. I'd be happy to answer those. You can call me or send me an email. With that, I'll turn it back over to Nikki. Thank you.
Okay, thanks, Terry. We do have a few questions. Would you like to address one or two now, or would you prefer to do that one-on-one?
Sure.
Okay.
Absolutely.
One of the questions, what methods do smaller firms, and they indicate fewer than 5 partners, use for compensating the partners handling most of the firm's administration?
What I see is if you've got a formula-based approach, then you need to allocate a portion of the profit pool to those administrative duties, and usually it's a set amount. It depends on how much of the administration is being dealt with by one person. If you've got one partner that's handling all administrative duties, if those duties are kind of routine types of things, things that a controller might do or a CFO might do, then we might establish a certain part of their salary based on their ability to do those things. If it's a managing partner, and that's what we're talking about, then oftentimes that needs to be more entrepreneurial and risk-based. So we might give them an extra weighting in their performance evaluations. Another technique would be to place a certain dollar amount per hour spent on a certain assigned administrative tasks with a limit. I wouldn't recommend that not have a limit, but so we might pay, for instance, $75 an hour for certain administrative tasks up to a certain number of hours per year. But those are the ways that I see compensation allocated for administrative tasks.
Okay, another question is, do you see issues when retired partners continue with the firm, such as problems with transition of clients?
I see that when firms don't have a transition plan in place. So, for instance, if you just sort of let things happen, don't expect the person to go through a transition. You need to have a written transition plan in place, and it needs to be executed. And if you can do that and you're able to do that, then you shouldn't have a problem with having retired partners hang around, because actually they're very beneficial. They can bring in new business. They help maintain the perception of continuity within the firm. But where I see it be a problem is when firms have not gone through a formal transition process with respect to retiring partners, and then all of a sudden they wake up one day and realize it didn't happen because the guy hung around, and they want to blame it on the fact that he hung around rather than the fact that they didn't have a transition plan in place that they tried to execute. Next question.
Okay, thanks. The next one, have you seen agreements that allow retiring partners to leave and take clients with a reduction in retirement payments?
Only if it's a, usually I see that done on a negotiated basis as opposed to a pre-arranged agreement within the firm, unless there's a specific partner with a specific situation. So for instance, a partner that does litigation support. And we knew that in advance. We might have said, look, you can take your litigation support practice. We don't want to pay for it anyway. But it would oftentimes it might be the result of a negotiation where we might have, look, I'd like to leave, but I've got my friends and relatives, or I've got this portion of the practice that only I do anyway, and why don't I take that with me? And so I'll see those kind of call-outs done on a negotiated basis, or in case of special consulting type of practices where the firm doesn't feel like it can continue on in that area. If the partner's going to take something and end up competing with the firm, I think that's a problem. I think just say, well, you go off and do your own thing, and we'll just see what happens. I think that can cause issues. Next question.
Okay, the next question, would you calculate death the same as retirement and fund it through life insurance, or would you calculate the buyout amount differently?
I would normally try to value death the same as retirement, as long as it's funded through through life insurance. The issue with death is that it's no different than someone leaving and not providing notice. It's a sudden event, and it can have the same disruption on the firm and therefore loss of business. But you can insure that risk, and you can make it affordable for the firm to go through dealing with that risk if you have insurance in place. So I do think that and part of this is just what feels right. It feels right that a person who has died, that their estate be paid full value for their interest. But again, I think it requires insurance. If you're unable to buy insurance or unwilling to buy insurance, then I think you have to deal with it as if the person had left without providing proper notice, which can be dealt with either through looking at post-retirement or post-termination retention of clients, or can be looked at as a set amount of reduction in value. It's a little more difficult with disability because you have lump sum disability insurance is very expensive to acquire, and most firms don't have it. So disability, oftentimes, what we'll recommend is that disability, in fact, permanent disability that requires a buyout of their interest, be dealt with as if it was a termination without notice. Next question.
Okay, the next one, how does compensation from working on your own accounts differ from working on another partner's account?
Well, again, when you're working on another partner's account, you're probably just providing billable hours. So, I mean, I would probably, if I was going to do a pure formula approach, and, obviously it depends on the situation here, but I might look at that and say, I'll just pay 1/3 of the billable time as the compensation for working on another partner's accounts. When you're working on your own accounts, you're not only providing the service on that account, but you're also managing the relationship, and that's what a partner is all about. So I think that the compensation with respect to a system that has a heavy emphasis on books of business and chargeable hours, your book of business, you're managing a book of business is one of the highest values a partner can provide. So I would normally compensate that at a higher level. When you're working on your own book of business, though, oftentimes you'll capture the value of doing that within whatever you're paying for managing the book of business. So it depends on how you've set your system up in general. But I would usually pay for, on another partner's book of business, maybe 1/3 of the billable time.
Okay, well, great. Thanks, Terry. We did have a couple more questions, but out of respect for everyone's time, we'll go ahead and end here. And Terry, I'm sure you'll follow up directly with the folks that we didn't have time to answer. Is that correct?
That we can do that, yes.
Okay, Great. Well, I'll be
Okay.
sure that Terry gets those questions. And thank you, everyone. Again, if you registered through Transition Advisors, you'll receive an email from me with a link to an online survey that you'll need to complete for your CPE. If you registered through CPA Academy, you'll use the normal process through them to get your certificate. We'll end the webinar now, and as a reminder, there will be just a brief survey to pop up. If you complete that, you can indicate whether or not you'd like a PDF of the slides or even some additional articles that Terry recommends reading for more information about these topics. Thanks again for attending, and we hope to see you at a future webinar.